Well, thank you guys for joining us today. Glad you could join us for another webinar in our series. Today the topic is how to invest in the movie industry. And we have two presenters with us today. We've got Daniela Ganella, who is going to lead the discussion. She is the founder, DG Productions, a relatively new London-based company, and is one of the forerunners in a new generation of filmmakers. She's worked in broadcast television for more than 20 years. In a number of different positions, and she's going to be helping along with John Robleski, who will be giving our presentation today as well. For those who are on the call today, we have a question box in the lower right-hand corner. As questions come to you, go ahead and type them in. We'll go through the slides and give you some good information here, and then at the end we'll stop and take your questions, and I'll read them off. So as they come to you, go ahead and just type those questions in as well. We are recording this, and we'll try to make that available afterwards along with the slides, but sometimes the recording doesn't always work, so let's make sure you stay with us on this presentation as we go through it today. So with that, let's go ahead. I'd like to go ahead and pass it over to Daniela and John, and we'll go through the presentation.
Hello everyone, this is John Robleski. Thank you for coming to the webinar today and attending, and also thank you to Hall. We're going to go ahead and just roll right into it. So this is a little bit of background on our producing team, which Daniela, you can see her credentials there, along with a producing partner of ours, Jay Michelson, who unfortunately couldn't be here. To touch on myself a little bit, I'm a financial consultant for the film industry, and own a business services firm for the film industry, and primarily focused on independent films between $1 million and $50 million. And Daniela, if you want to touch on you and Jay's background as far as from a production standpoint.
Yes, good evening everyone. Yes, I come from a television background, and I moved into film several years ago, and I have a slate of movies that I have in production at the moment, and I joined forces with Jay Michelson, who, as John said, unfortunately couldn't make it today. He's actually in India closing on a movie. And it gives me great pleasure to be here tonight and to be able to speak with you guys regarding film.
So, and honestly, when you look at the production team that they have, they focus a lot on top-notch independent films. You can see Jay's currently in production on Bloody Indian, which is what he's closing in India, and that's a $40 million movie that he raised himself. So if you've ever been around business financing and raising funding, raising $40 million by yourself is no small feat. So we're going to go ahead and talk a little bit about why investors would look at the film industry. So a lot of investors, when you look at the film industry, they're a little bit spooked because you don't have a firm grasp of what it means to invest in a film industry. When you invest in a film, you get a executive producer credit, and you get to be involved at the movie industry at the highest level. Typically, when you're working in the film industry, just like with any other industry, to reach a top level, it's going to take quite a bit of time. Luckily, in this particular field, holding the money also gets you access straight to the top. From an investment standpoint, when you talk about target market, there's a large target audience in films that typically exceed standard averages. Unless you're going into primarily tech fields, film is really going to be one of those areas that's going to be able to reach more people. But also it has unique financing structures to where you're able to maximize returns in other places where you might be kind of minimalized. There's also ways to produce as far as high-quality product through efficient planning and experienced teams and project structures, which we'll touch on, which also goes back into maximizing returns for investors. We'll also touch on filmmakers, how to prepare to pitch to investors, but also how to structure your deal to where it's appealing for investors, but also appealing for you, because at the end of the day, filmmakers have to make money as well. And then again, when you look at the large potential uplift as far as investing, say, $1 million to get a couple 1,000% return, there's very few industries where you can go ahead and achieve that kind of return. and even a well-structured and properly planned film, even if it only has moderate success, can at least break even, which I think if you are more on the business side, you understand that that's a feat in itself. So we'll kind of talk a little bit more about that. So really when you break down film financing, the way we look at it as producers and financiers is there's the low-risk investment, which is going to be your studio films. Those are going to be very large budgets with the top cast and top crew, but in conjunction with that, you're going to pay top rates. So you might spend $100 million making a feature, but you might not necessarily see the returns based on that because the upfront costs and the initial expenditures are so large. And then you also have, the high-risk films, which are going to be kind of your first-timers. Typically, with that, you're going to want to surround yourself with a stronger production team. And from an investor standpoint, how to allocate that risk and kind of soften the blow, per se, is going to make sure you're going to have to ensure that the rest of the production team is really strong. And then there's the brilliant, which is a lot of what Jay and Daniela and I really work on. It's the $40 million movie that's made for $4.5 million. It's really those studio quality films with A-list actors and A-list crew members working for less, and that's also going to optimize the rate of return for the investors. Daniela, if you want to go ahead and talk a little bit more in depth about this, since you're a little bit more involved in this type of structure.
Yes, thank you. As I said, Jay and I and John we're all working together. We all have our different strengths, and this is one way where we can come together and have that strong unit. Now, in terms of the production team, I would say very, very, very crucial that you pick your team well. You're going to be with them for a long time, and as I said, everyone has their different strengths. You need to be able to pick your good production teams, heads of department, your line producer, your production managers, etc. Really, really important. But first and foremost, even though the production team is really important, having a very good script is, I would say, one of the most important things. And together, you can work on the script and gauge from there, first of all, your budget, which is where John comes in, and then your cast, your heads of department, as I said. We've managed on several of our movies to be able to secure key heads of department, directors, DOPs, etc., but also the cast. We have people like Adrian Brody, which the movie that John was talking about, Babylon Sisters, Jessica Alba. All these actors, they're looking for good scripts, strong scripts that they can excel in as actors, and they don't mind that the salaries on those are lower than the studio movies. They want to make good movies, and they want to embrace people like us, people that are trying to achieve independent movies for the 4 million mark that would normally be in the region of 30 million. We all gain from that. And more importantly, the investors will recoup much quicker. And in terms of the target audience, the goal of this strategy, as you know, is to understand your market. I mean, if you don't know your market, you need to do your research on that. If you have a horror, you need to know which.
Danielle, are you still with us? Sorry, she's coming in from England, so we've had a little bit of shaky reception with her. One of the things that we've really talked about is from a target audience standpoint is you really have to identify what type of film you're making. If you're making a low-budget horror film, you need to understand that looking at your target audience in a specific manner might not be as broad as, say, making a $20 million blockbuster. So knowing and understanding where your market and how you're going to reach at is going to be an important play into our next segment, which is distribution. Again, this is where you have to be extremely honest with yourself. If you're making a low-budget horror, probably securing distribution, which is how the film actually reaches its audience. You're probably going to want to secure that up front. That way, when you sell the film up front, you've at least recouped that initial investment for your investors. Now, with a stronger movie like what Daniela was mentioning, Babylon Sisters, with cast members like Adrian Brody, Jessica Alba, that movie also has Ava Longoria, they know that they can at least recoup, that budget's at about $5 million. They know that they're going to do that probably at least in foreign sales, just alone. So waiting on completing the film and then shopping it for distribution is very important, because you don't want to sell the film up front before it's made for a lower dollar amount that you could get after the fact. So this is all kind of strategies that play in with your target market, your target audience, and being very honest with the type of film you're making. Because just as good filmmakers, you have to do your due diligence just like investors do. So you have to be able to ensure that you're going to recoup some of that. Now, one of the things we did skip was a little bit of terminology. And so one of the things we'll kind of talk about is above the line and below the line. I'm going to go ahead and go back to that slide so I can touch on that, so we make sure that everyone's kind of on the same page when we mention a few of these things. So your above the line is everything that you're going to want to try and get attached as a filmmaker in order to secure investment. A lot of times it's going to be very difficult to go ahead and get an investor to sign on to your film if you don't have proven actors, proven directors, or proven producers. So getting people to go ahead and come together at this level, and screenwriters as well, at this level early on is extremely, extremely important, and that's where a lot of filmmakers really fall short in capturing investment. It's difficult to go ahead and get someone to fully sign on as far as before you have money, because most of them want to see the money first. But if you can go and obtain LOIs, letters of intents from both sides to be able to document that, that's really going to make your case very, very strong. The movie industry is a little bit different than most business industries, whereas a lot of things are done based on intent. But if you can secure that and everybody's on the same page, you can really make some great things happen. In conjunction with that, everything below the line in terms of budgetary standpoints is everything that's going to happen pretty much after the fact that you started production. A lot of those aren't going to necessarily have to be addressed right up front, although you would like to have a steady game plan in order to secure all of that. There's a couple definitions that aren't on the screen. One, again, was distribution, which is how the film is going to go ahead and reach its target audience. But then also we're going to talk a little bit about finance structures. And when you talk about financing a film, there's no one way to do it. And a lot of times there's multiple ways to finance a film. If you're working on a $40 million picture, you might go ahead and have equity investment up front with debt financing for the bulk of it, and you might even have asset-based lending structures, which is where they collateralize the film against maybe a bank loan. So those are a couple things we want to touch on, but I want to make sure everyone understands that, from a film financing standpoint, there's no standard way to do such. So equity, again, is participation and ownership. Debt financing is when you're going to pay back that initial investment plus interest over a specific period of time, and asset-based lending is where you collateralize the loan against a specific type of other lending structure. Okay? So kind of back to our same points as before, we're going to go ahead and touch a little bit on finance structures, and we actually have some examples that will show you exactly how the revenue is flowed. But again, like I was talking about a little bit before, there's three primary structures. I'm going to go ahead and show a typical structure. So this is from the movie Crash back in 2005. The reason why we like this example is that same film we keep referencing with the Jessica Alba and Ava Longoria and Adrian Brody has the same director that directed Crash. So these are very real possibilities from an investor standpoint, and this is really our preferred model because when you look at the Napoleon Dynamites and you look at some of the smaller budget films that had high rates of return, a lot of people try and focus on those not coming around very often, and that's just because they're not pursued very often. If you actively pursue a construct like this, you can absolutely make it happen. So if you can see there at the worldwide, we're just focused on theatrical gross. I did put the home market sales, which is going to be your video on demand, DVD, and Netflix, and all of that, and that's at 120 million to date. It says 120,000. It's actually 120 million to date, but the worldwide theatrical gross was right around 98 million. And when we use the rule of the thirds, which is basically from your worldwide gross receipts, about a third of that money is actually going to flow down to the investors and the producers. And all of the investors and producers, they are typically going to do a 50-50 split on that money. So as you can see, you have 98 million that comes in. By the time you get it back to the producers and the investors, it's going to be about 33 million there. And as you kind of break it down from the production budget to pay back that initial investment, all of your marketing and advertising and distribution fees, your foreign sales expense, residuals, things of that nature, you're going to have about 23 million left over, which again, the investor and the producer are going to go ahead and split. So as you can see below, if an investor went ahead and put $7.5 million into that production budget, he could easily see about almost close to $12 million just from the box office. Again, that's 120 million on the home market sales, which again is going to be split back. So you can be pretty safe to say that that investor is probably going to make close to $25 to $30 million off of that film. But it's important to note that when you do a construct like this, there are no buyout clauses and there are no real exit strategies. You are going to be permanently linked to that film, and as our friend Jay likes to call it, it's just mailbox money from there. But you do own half of all of those profits that come in. And so when we go back and we're going to talk about again about the attachments and again the above the line preparation. So this is probably the most difficult aspect for most new filmmakers because just like with a lot of industries, it really is who you know, and the film industry seems to be very much one that holds that true more than others. But it can be obtainable. So going ahead and making the right relationships and securing A-list cast and crew will help from an investor standpoint to a distribution standpoint, because then everyone that's involved in that film, whether it's the distributor or the investors, kind of mitigates that risk of losing money. Again, we know that for a fact that Adrian Brody can do about $5 million in the box office in specific areas. Well, if the whole film budget is $5 million, we sit at a pretty good spot as far as investing in that film. So for a new-time filmmaker or an investor, really looking at what's secured from a cast and crew standpoint, primarily with the crew, because like Daniela was saying earlier, a lot of the team and those heads of production are going to go ahead and be securing specific time frames and making sure the film is on budget. And those are things that are really, really important, especially when you're looking from an investor standpoint. There are specific investors that will invest for all sorts of reasons, and we'll touch on tax incentives here in a little bit. But if an investor is going to go ahead and try and do, say, a write-off in the fourth quarter and the film is sold late or it doesn't happen, well, they might not get their write-off that year. Now, again, it all comes back to kind of the baseline preparation and the contract. If the film goes into what's called principal photography or starts production in that year, that investor can go ahead and get that tax write-off that year. But again, timeframes are extremely, extremely important. So again, the more above-the-line preparation you have, the better and the faster you can go into production. Okay, and then we're going to go ahead and touch a little bit on tax incentives. We don't want to get too deep into the weeds per se on this particular subject, just because it does get complicated based on where you're shooting the film, and so that's primarily going to be the job of the producers. They're going to need to ensure that they fully investigate all of the tax advantages that can be taken advantage of by the film based on where it's shooting, how much it's spending. For instance, if you're going to shoot half of the film in California and half of the film in Louisiana, and you might have better tax incentives in California, well, then you might want to go ahead and move some parts of the picture to shoot maybe, say, 70% in California. And then, again, that's just doing your due diligence, but investors need to be aware of that as well. You know, when you're dealing with the money that some of the film industry takes, you know, losing a couple tens of thousands or hundreds of thousands of dollars in tax incentives can be a very, very big deal at the end of the day. But it's definitely going to be something that any tax incentives is going to be realized or either paid back directly to the investor at the end of production. So you really need to make sure that you're on top of that. I think, Daniela, are you back, and do you want to touch on that at all?
I am. I'm so sorry. I do apologize profusely, which is why everything went so wrong for me with my computer before we came on, and then, as you could hear, I came off. Yeah, everything, John, I was listening to the tail end of what you were saying, and yes, on every single front, you're right. And if I may, do you mind if I go back to one of the pointers that you brought up, that
Sure.
with the tax incentives, especially, you can actually, if you have, like one of our scripts, Babylon Sisters, primarily we wanted to shoot in the US, but if the investors were British and they wanted to shoot there, the tax incentive here is absolutely incredible, and so therefore that would be a good enough reason for us to move the whole production to the UK. All the investors could be from the UK and say, well, look, we'd like to keep it US and make the most of the tax incentives in whatever region we decided to choose. So you can sort of move things around accordingly and for whatever is best. I mean, each state in America has different tax benefits and some don't have any at all. So it is worth doing your research on that. And if the script is given in a certain area, you might want to change that, and it's very easily done.
Right. So I did want to take them through a little bit more of the finance here, the finance structure, especially how it ties into distribution. So let's go ahead and so this is a sample of basically what an investor and what a filmmaker would present as far as what a typical finance structure is. And I say typical, again, it's not going to be typical, but this is an equity participation with 108% recoupment, and again, that 50-50 profit share agreement, and again, that's in perpetuity. But how this really ties in from a distribution standpoint is when you're looking at the money coming back. So most of the revenue that you're going to see from the box office is going to be secured in about the first 6 months after the release of the film. That's really going to be a great gauge of how well the film is going to do at the box office. A lot of times, I'm sure plenty of people have seen it, that's why they re-release films many times in the box office, but they'll also have testing target markets, which is not necessarily a bad idea, where they'll release a film, say in 3 locations, and if it does a certain amount of revenue, then they'll go ahead and expand it to go ahead and go nationwide and sometimes even worldwide. In conjunction with that, when you look at the home market sales, again, when you looked at Crash at that $120 million, a lot of that's going to be realized within the first 2 years of that film. Now, again, there's no standard for it, and there's plenty of films that make money long, long after that. But just from an investment standpoint, looking at recouping a majority or most of that 108% in stepping into that 50% profit share agreement is typically going to happen within the first 3 years. So from an exit strategy standpoint, which again there's not really one, but if you're looking at from a recoup standpoint, 3 years is going to be about average. And when you look at most deals, and there's slow money deals, whatever it might be, you might be looking at 5 to 10 years. So for an investor, again, if a film is done properly, the returns can be very great, and they can actually be rather quick. But again, it's going down that checklist and doing your due diligence. Again, did you want to touch on this at all, Daniela?
Absolutely. I think that due diligence is one of the key factors here on every single front. Actually, John, you can't continue on that vein. I'm sorry, I'm having so many problems here. I can't read any of my notes or anything here. Would you mind? I'm really sorry.
No, sure. It's quite fine. You're over in England. It's fine. So when you talk about due diligence, I think that one of the other things we didn't really get to touch on. I'm going to go ahead and back up. But I'll touch on this. I mean, if you understand here, when you're reading through this, there's no deferred payment. So that's one of the big things that is in this industry is deferring pay on the back end to say specific actors or specific crew members. Again, those above the line attachments. When you go ahead and you budget that you're not going to defer any pay for anyone and you're going to pay them up front, again, that's where that 50-50 profit share agreement really starts to come into play, and that's where you'll typically see a lower interest rate on that initial recoupment after principal. So that's why this is only at 108%. There's some films that'll go to 120% with deferred payment on the back end. There's actually some that we've seen that'll give 200% recoupment with the 50-50 profit share with deferred payment. So understanding the language as far as no deferred payment means you're not going to receive as much interest after that principal is recouped, again, is important to an investor. And pretty much in conjunction with that, you also see at the very bottom, I do want to point this out, and funds will be in the production escrow account for at least 6 weeks before principal photography. So where Jay actually just went to secure that film, he's about 6 weeks out from starting production, hopefully, on that film, which is why he's going to close that deal. That's important for all parties because they need to understand that once the funds are in the account, it's what's called greenlit, and it's a go, and everyone really needs to be on top of their game. And if you don't know, an escrow account is basically a mutually agreed upon account that funds are only distributed from on a specific basis. So for production accounts, only specific people have access to them, and the funds can only be distributed if specific requirements or guidelines are met. Until such, they cannot be pulled out. But that is why you use an escrow account. And it also has typically a manager over the account, so everyone knows that the funds are safe, and especially when you're dealing with quite a bit of money. But now I'm going to go ahead. I'm going to back up, and we want to touch a little bit more on the script and target audience viewpoint, because I think it's important to go ahead and look at that a little bit more mainly from a filmmaker standpoint. Okay, and so when we talk about script and target audience, as a filmmaker and even as an investor, one of the things to really look at from the script standpoint, you need to look at the genre, because genres have clear defined fan bases and proven track records. In conjunction, again, with your attachments and your above-the-line preparation, this is how a distributor is going to go ahead and be able to estimate how much your movie is going to make. Again, I like to use the analogy of the low-budget horror film, but that's because there's proven track records there with specific target audiences, and they know that those films will do well in specific markets. So when you're writing a script or when you're reading a script and looking to invest in it, recognizing that right off of the bat is going to be important to understand what type of return you're going to be looking at. In conjunction with that, castability is extremely important. So who can you cast and put into these specific roles? Again, that goes into the above the line or the attachment section, but castability is something that most people really don't think of when writing or reading a script. For instance, the example that you looked at from the sample verbiage, Criminal Empires for Dummies, that film was actually written with a specific actor in mind, and he's a big name actor. And once he signs on to that, that budget is a $12 million movie. That actor is going to take half of the money he typically does just because he knows that script was written for him. That particular actor, his movies average about $100 million a piece. So again, doing a film for $12 million, knowing that you're even on a very low end going to do $80 million. Again, when you use the rule of the thirds of what funnels down back to the investor, that's going to be a pretty good day for everybody. So I think one of the main points is, again, when they say most films lose money, that's not necessarily true. Poorly planned movies and poorly executed movies lose money. Again, when you properly plan it and you execute it, even a moderate or bad return on a film can actually still break even. So it's these key points that you're looking at here that we really try and hone in on and really try and get these as far along as possible. I think at this point, I'd like to open it up for questions just because I think that's going to kind of open up the dialogue a little bit more.
Okay, well, great. Thanks, guys. For those who have questions, go ahead and type them in the box, and we'll read them off and answer them. Several have already come in while you guys were presenting. The first question was, can you guarantee investors will get 1/3 of the profits from a movie?
It's all based on the construct. When you look at, say, for instance, asset-based lending structures where they collateralize the loan against something, a lot of times what's going to happen is they're going to go ahead and have an irrevocable guarantee against that collateralized loan where whoever is offering up that lend or that finance, they're going to go ahead and they're going to see their money back regardless. You can't ever guarantee anything, but that is one way to do such. When you look at an equity participation, a lot of it's variable based on what the distributor is going to take as a cut. A typical distributor, is if it's an upfront sale, which again you don't want to do an upfront sale or an outright sale. If you're going to go ahead and do what's called a revenue share with them, their typical take is going to be about 25 to 40%. So when you're looking at guaranteeing anything from a distribution or return standpoint, it's going to be up to the distributor deal, which is where it becomes important. But with the distributor, typically what you're going to try and do is you're going to try and do, say, like a 35% where the distributor gets 35%, and then you have what's called a sliding scale on the back end to where over time or as they get a certain amount of money, that percentage goes down. But no, you can't guarantee that you're going to get 33%.
Okay. Next question is, can you explain again what deferred payments mean?
Sure. So a deferred payment would be, so for instance, we have a film currently where we were going to get Tommy Lee Jones to be in the movie. Tommy Lee Jones requires $1 million up front, but he also requires 5% of the total participation of the film, meaning that a certain percentage of those profits are going to be allocated back towards Mr. Jones. So when you look at that, that is a deferred payment. In conjunction with that, what you might also have is a lot of people want to get involved in the movie industry. So you might have cast and crew members that will come on for very, very cheap with a deferred payment option, and once the movie makes a specific amount of money, then they go ahead and get their proper payment, whether it's to scale or whether it's a lump sum.
Okay. Next one is, I have a micro-budget film opportunity less than $3 million with no big names attached. Is that a good deal?
Well, again, you got to run down these points that we're looking at right now. If you're looking at a micro budget, $3 million isn't, it really depends. If you had distribution secured, and you had a very aggressive finance structure in conjunction with that, if you didn't have any attachments from an actor standpoint, you would probably want to staff it with a very experienced crew because there's directors and directors of photography and producers that alone will go ahead and bring money in. But $3 million, again, there's too many variables to really say. And again, you got to look at what the script is, because if you don't have a good script, you really don't have anything at all.
Okay. How many deals are getting funded in the state of Texas?
Oh, I wouldn't be able to answer that question.
Okay. Next one is, when people invest in a feature, what can or should you promise them?
Well, I think that I'm gonna go ahead and flip through it here. I think that this right here is what you would look at promising them. 108% recoupment, which again, they're in the first position, which means that the producer does not see any money until that investor gets 108% back. And then from there, it's a 50-50 profit share agreement. I think that is something that's, if you're going to promise anything, at least promise you're going to get your investors, or you try your best to get your investors' money back. But again, that also ties back into that distribution like we were talking about. If you have a $4 million movie that you have a distributor go ahead and say, as soon as you're done with that, I'll pay you $5 million for it outright, but you don't see any back-end participation, well, then you could promise your investor, or your investor could hold leverage and say, okay, I want you to sell the film, that way I know I can recoup my investment. Again, you're going to leave money on the table, but for some investors, that's the safe route, and that's the way they want to go. But that's all tied back into, doing business with an investor and a filmmaker.
Okay. Next question is, aside from the business model and name attachment and event distributor commitments, does shooting a trailer and spending money on that really help bring in investment, or do smart investors see past that?
No, I think that's a great way. I think that's a fantastic way to raise money, because the investors and the distributors get a chance to look at the film and realize what it's going to look like. But in conjunction with that, that shows a due diligence on the filmmaker's part based on the fact that they went out there, they probably had to raise some money to do such, and they've already been aggressive. That kind of says, regardless, I'm going to do it, so whether you help me or not, that's kind of up to you. But I think that's a great way, and you actually do see those. A lot of times they're called lookbooks or teasers. I think that's a great way to do it.
All right. If you invest in a deal that doesn't have a distribution agreement, aren't you taking a big risk that it will never get distribution?
Well, again, that's where it ties back into what are your attachments and your above-the-line preparation look like. Again, with that film with Adrian Brody and Jessica Alba and Ava Longoria, no, because we believe that, at a minimum, and we've already gotten basically some quotes from distributors saying what they would pay for a film like that. So what we want to have on our hands is more of a bidding war, because it creates a sense of urgency when you go ahead and screen a fully completed film that is well put together. You can go ahead and show people, that you could be making money off of this, and then again, that's where you hold the leverage, and that's the position you really want to be at as a producer, is having that leverage over those key decision makers.
Right. What movie genre is the most profitable for investors?
Oh, I don't know. I'd have to look at numbers.
Okay. Next question, will these slides be available for download after, or can we watch this again afterwards? Yes, we are recording it, and we'll put the slides up on the website so you guys can go back and review this material later. So certainly we'll do that as well. Let's see. Next question. Oh, okay. Well, I'm not sure what they're asking on that one. Let me go to the next question. Aside from revenue shares, what other financial structures do you typically see out there?
Well, debt financing is a pretty big one. So there's some lending structures or financiers that will just require 120 to some 150% return, and then after that they don't want to see any back-end participation. I don't really see why you would want to do that. It doesn't make sense to me, but there are some that like to do it, and they've all got their reasons. But that would primarily be the only other one besides doing with the asset-based lending structure. A lot of times what you'll have are what's called options on the actual material and film itself, to where you can go and actually shop that, and so somebody might purchase an option on the film for a specific amount of money, and then they'll finance it and then get an option. They'll go and sell that option, kind of like a stock, for a markup. You will have some people that do that, but that's kind of gone away as of late.
Okay. Are you aware of any tax structures for sheltering your investment return from a film?
That's a difficult question. Yes, I am. I would ask that person to reach out to me, because that's a pretty those get very complicated. You do have specific ways to shelter it, whether you collateralize it through. There's been people that have collateralized loans through whole life insurance, tax-sheltered annuities. But again, things of that nature, you're really starting to get really into the weeds. But not only that, those are people that have very specific things in mind, very specific constructs in mind, and they have a preset agenda.
Okay. While we have several more questions coming up, you may want to go ahead and put your email address up there, John, so people can get back in touch with you directly on this. While we're doing that, the next one is, what about crowdfunding of film and then getting investors to help with marketing and distribution costs? Do investors find this appealing?
Yeah, I'm actually really glad somebody asked that question, because that's something that, and Hall, I've actually spoken with you about that. So I think it's something that's, crowdfunding is becoming much more common in all types of lending structure, and I think film is a great way, because filmmakers more than most will look out for their own, but not only that, you can create a specific amount of buzz through just crowdfunding itself. Myself, I've never been involved. I've been involved in smaller crowdfundings, but not at these volumes. But that's something that, with SEC regulations, there are specific manners in which you can do such. Because again, when you're raising equity financing, you do have to go ahead and there's specific private placement memos that you have to put out, and you have to go ahead and have specific risk opportunity and risk engagement verbiage that follows with it. But as that kind of pans out, that's something that a lot of people are looking into, but I think we're kind of still waiting on all of the rules with crowdfunding. Hall, would you have anything to add to that?
No, I think that covers it pretty well. The next question is, how important are film festivals and marketing a film?
Huge. Especially when you look at, from a distribution standpoint, if you're going to wait to complete the film, then distribute it. Again, I used Napoleon Dynamite as an example earlier. Napoleon Dynamite went to film festivals, and that's where it had a bidding war and ultimately where it was sold. I think it's a great way to go ahead and make a splash. We have one deal right now in particular where that filmmaker went to Sundance, had a really great showing at Sundance, and now he's going to be able to go to almost any major lending structure and probably get a film of under $5 million financed just based on the fact that people know him and he's starting to have a name. And it's all about building a brand, and film festivals are one of the places where you can really build a brand. But I think it's the biggest for a distribution standpoint.
Okay. Understanding there is no sure bet, can you give an example of a few A-list actors that might attach their name to a film that you would follow in with an investment?
Oh, I mean, tons. I mean, I think if you just look at, the other thing is to look at from a sales perspective, this industry, actors and attachments hold a value that's updated almost daily, and distributors and sales agents always know exactly how much that person is worth at that time, and it's not necessarily that week or not necessarily next year or last year. It's literally at that moment that you're signing that piece of paper what they are worth. So I mean, there's you look at, the Brad Pitts of the world, at a minimum, you put that guy in a film. I think his new film that's coming out is a great example. For a minimum, that's probably going to do about $120 million through its life, if not just at the box office. So I think it's extremely important, but I can't pinpoint one particular actor that I would try and invest in.
Okay. What is the best way to market a completed film to a distributor?
Show it to them. Have a private screening. It's not too long ago we had a film called The Wedding Palace that actually came to Austin. Good friend Paul Kim and Eric Robbins and I put on an investor screening for them for Distributors and Merrill Lynch, and she was able to secure finishing funds and distribution through that. So show it to people.
Do most distributors distribute worldwide, or does a film need a distributor in each country?
Typically, the distributor is going to they're going to have specific segments where they're specialized. Like Daniela is talking about, in England, you're going to have specific distributors that are going to focus on regions. It's also because they have connections in those areas. They know how to kind of work the region in conjunction with the tax benefits and the financing structures. So if you look at most films, there's going to be main distributors, probably 2 to 3 main distributors that'll go worldwide, and they'll have smaller distributors, branch outlets, affiliates, subsidiaries that will go ahead and handle the regional markets.
Okay. That covers all the questions. If you guys have any more, go ahead and type them in now. As you're doing that, I'd like to go ahead and put in a announcement that we will be holding a film funding forum in Austin on January 10th from 1 to 4 p.m. That's a Thursday, coming up here in about 4 weeks, in which we will invite entrepreneurs who have film deals to stand up and do a presentation to investors. So if you're an investor, invite you to come out and sit on the panel. If you're an entrepreneur, invite you to come out and pitch. Just send me your exact summary of your deal if you would like to present, or just drop me an email if you'd like to be on the investor panel. We'll do some mail shots here in the next couple of weeks to highlight that and give you guys a chance to sign up. But hopefully you'll take what we're teaching here and be able to apply it in that film funding form that comes up. One more question, John. I want to learn in simplest terms the basic steps from beginning to end to get a script and turn it into a successful dollar-making film. Are there any great first people to contact here in Austin, or books that help people learn step 1 to the final step?
Well, yeah, me. Well, yeah, there's lots of great ones. There's a film financing. There's a how to. I'm trying to think of the exact name. Louis Levinson wrote a great book, and I think it's just how to finance a film. But Louis Levinson's book is great. But if they're interested, they can email me. That's a lot of what we do at my company is we go ahead and we take scripts and we take them from start to finish, like the ones we've been talking about, the Babylon Sisters and the Criminal Empires for Dummies. So if they're interested in that, they can be more than welcome to reach out to me. I'll be happy to have a chat.
Okay. Is there any additional incentive for crossover actors such as Ashton Kutcher, who has a large following both on TV and film?
I'm sorry, what was the question about the crossover?
Is there any additional incentive to have crossover actors, so those coming from those who have a large following on TV that are now moving into film, is that an extra draw for the investor because it may have a larger base, I'm assuming? Yeah,
there are, and but honestly, what you see with a lot of those is that's where you have like the Christmas time movies or the seasonal movies where Chevy Chase is coming out with another film and they just or Robin Williams or whatever it might be, and they know that it's going to sell a certain amount. So yeah, there are a little bit of added incentives there, but you do have to be careful with those because again, the sales agents know exactly how much how much money those guys are worth at that particular time. And it really has to fit the project. People like that are going to have projects built around them and around that fan base, and typically that's when you're looking at those studio films. So as an investor, you're probably not going to make as much money on those. They're more considered what's called safe but some of them definitely tank. The last couple Nicolas Cage movies I think are a great example, and he's actually having to look at crossing over possibly. So
I gotcha. All right, guys. Well, thank you so much. I got one more question here. Can you comment on GAP loans, GAP loans? Should they be avoided? They appear to be very costly in the way of giving up equity.
Yeah, GAP and super GAP financing is extremely costly. We just dealt with a deal where they basically if you look at it, you're basically doing every dollar you get you're having to pay back too. Yeah, they're extremely costly. But a good friend of mine, Grant Sowery out in LA. One of the things he always says is, do you want to sit there and be talking about, how you almost got the deal done, or do you want to get the deal done? So I think they make sense in specific areas, but you got to understand and kind of prepare yourself for that. You're losing money, but if it's the only way to get the deal done, it's the only way to get the deal done.
All right. Well, great, guys. That answers the questions for today. Thank you for joining us. Thank you, John and Daniela, for presenting this information. And we will post the slides on the Texas Entrepreneur Network website under webinars. You can go back out there tomorrow and find the slides and the recording and review those. You have John's email address there. You're welcome to reach out to him directly with further questions. And by all means, mark your calendars to join us as either a presenter or an investor or an observer at the Austin Film Funding Forum on January 10th. So with that, we'll go ahead and close it out. Thank you guys for this, and have a great weekend.
Thank you.